Greetings and a warm welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA channel and CEO at Trout, TPSU, and 401k TV. I review all of this week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story. The battle over DC participant data continues, with Schwab, the latest, requiring users to reset credentials and voiding guarantees if shared with third parties. It is a clear shot at firms like Pantera that enable advisors to manage their clients' DC accounts. Pantera has recently called out Fidelity, which, citing concerns about cybersecurity, has banned Pantera on their platform. The battle over data and who can use it is only going to heat up as both record keepers and advisors look to leverage their relationships with DC participants to cross-sell financial services. But the Pantera service is different. Participants are granting their existing advisor the right and ability to manage their DC plans, deploying extensive cybersecurity protections. Interesting that the two record keepers that have the most success cross-selling to participants are pushing back, while others like Manulife, John Hancock, and 401go are working with Pantera. Next story. While the Q1 deadline to the DOL and the President's executive order to clarify how private market investments can be made available in DC plans will likely not be met, due in part to the government shutdown, Morningstar, through its affiliate PitchBook, will be releasing the Evergreen Fund indexes tracking these investments early next year. The goal is to bring greater transparency to these mostly opaque investments, which include private equity, private credit, real estate, and infrastructure, expected to cover $1 trillion in assets in 2030, up from $450 billion mid-2025 and just $250 billion in 2022. Can PitchBook get under the hood on these private investments, which are mostly self-valued, and provide greater clarity and transparency to investors and plan sponsors? Next story. ETFs have mostly overtaken mutual funds in the personal investment arena, but not in DC plans because of the inability of major record keepers to handle them, all of which may change with recent filings of dual share classes. Led by State Street Investment Management, over 80 firms have filed with the SEC to offer dual ETF share classes of their mutual funds. ETFs have gained traction over mutual funds due to lower costs, greater transparency, trading flexibility, and growing scale. But the move to professionally managed investments like target dates, which are capturing over 60% of new contributions, as well as managed accounts, is growing, especially as the QDIA leaving less opportunities for ETFs. Perhaps they will be replacing mutual funds as the move to passive investment continues, driven by the desire for lower costs. Next story. Speaking of lower costs, a recent study by Wharton's Pension Research Council shows how revenue sharing affects fund selection in DC plans. Investments with revenue sharing are more likely to add and less likely to be removed, increasing costs to participants. Specifically, based on filing 5,500, just 20% of revenue sharing funds were deleted compared to 28%, while revenue sharing are twice as likely to be added. Though the recent trend shows reduction in the use of revenue sharing over the last few years, it is still prevalent, as is placement fees paid to record keepers by asset managers and private label funds that allow providers to leverage their general accounts or fixed income investments. All of which screams for RPAs to conduct even more thorough record keeper RFPs, something benchmarking will not cover, especially with growing industry consolidation. Finally, in his ongoing series about lessons learned from litigation, leading ERISA attorney Matthew Eichmann and former practicing RPA explains how a recent case against Caesars 401k can help advisors highlight the value of 338 co-fiduciary status. Caesars' motion to dismiss was granted because the court found that they had exercised prudence in hiring and monitoring Russell as their 338 co-fiduciary, while the motion by Russell was not granted due to possible loyalty issues. Eichmann opines that plans will not be held liable for acts of their 338 if they conduct an RFP to ensure that they are qualified, create and follow an IPS, get periodic reports, and document regular committee meetings. The case is a great lesson as more RPAs are acting as 338 co-fiduciaries, showing the value that this service can bring to plan sponsors. So those were the most important and interesting stories from the past week. I listed a few others I thought were worth covering, including IRS raises 401k contribution limits, newly formed Wellspire makes its first acquisition, Wells Fargo settles a 401k ESOP case for $84 million, and the PSCA annual survey is just released. Please let me know if I missed anything or if you'd like to comment. Otherwise, I look forward to speaking to you next week on 401k Real Talk.